Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 18th of September. And frustratingly, we're on US Fed watch yet again because the magicians are going to be talking later on in this week coming. And of course, thousands of analysts around the world are hanging on every word. I don't know why they bother. Because these people clearly don't know what they're doing and they don't have any real control over the global economy. But nevertheless, this is our reality these days. Everyone's watching what the Fed is saying and trying to determine from every word where markets may go. But look, all of this is noise. It doesn't change things in the longer term. The dips in the market create opportunities for us, and that's what the way we've got to approach the market. That this Fed-induced volatility is actually a good thing. It can be uncomfortable to work your way through it, anywhere from a period of a few weeks to a few months, but it does set up terrific opportunities. So let's have a look at what's been happening. As usual, I just want to make a few general comments, and I really alluded to this last week as well, and that is that we are seeing a rotation globally around the world from the risk-off approach of investors to be chasing yield and not worrying too much about growth. And we're now starting to see that rotate more into growth type stocks, more of a risk on kind of attitude. This is still a bit of a contrarian positioning at the moment because a lot of people are still quite fearful about what might happen, and sentiment is hardly buoyant. But then it's been that way really since 2008. But where we've been through probably 3 or 4 years of very risk-averse sentiment around the world, there's definitely signs that that is changing. So the very short term is really tough to anticipate. Markets could flick around a lot ahead of the Fed and then post whatever the Fed has to say. But we've just got to ignore that and use it to advantage. From my perspective, the longer term is still bullish, both from a fundamental point of view. I'm probably mildly bullish from a fundamental point of view, and I think, as an attitude to life, that's the way that you should be. I think you should be mildly optimistic at worst. So from a fundamental point of view, that's my positioning. From a technical point of view, I'm more strongly bullish, and I would place more emphasis on the charts than on which are really looking forward, whereas the economic data and the corporate data and the economic data is looking backwards. Speaking of charts, the Nasdaq and the technology sector within Nasdaq is doing really well. It's still above its 50-day moving average, and of course the Russell 2000 is also near its all-time highs. So whilst those two sectors are doing what they're doing, I don't think you can worry too much about the market rolling over. It's just not going to happen when those two risk-on sectors are doing as well as they are. I'm constantly on the lookout for new emerging trends. I think that's the way that you got to make money, and traders and investors have just got to get ahead of the curve, get ahead of the masses to be profitable. And you've just got to look where others aren't. And when something is drastically out of favour, it may take a year or 2 years to start to move. But once something is drastically out of favour, then and cyclically there's a good chance that it will rebound, then that's where you've got to be watching. It's just really a matter of matching the desired return that you want with your comfort level to accommodate the short-term volatility. And most people really struggle to get that balance right. And it's not an easy balance to get. You'll never be perfect at it, but at least you need to think about it. And in my experience of dealing with thousands of people over the last decade and a half, not many people give it hardly any thought at all, and that's why they get into trouble. The Chinese economic data, there's been doom and gloom around China for the last couple of years, but the Chinese economic data is still okay. It's not sensational, but it's okay, and I think the prospect of a hard landing in China is very minimal. Specifically, in the last month, there was stronger retail demand as imports rose for the first time in 2 years. So that was a good sign, and exports were expected to fall a fair bit, and they didn't fall by as much. So that was pretty reasonable data. What is really amazing in China is the growth in technology and technology companies, and the potential there, as you would expect, is just immense. I think only something like 10 or 15% of the Chinese population has access to the internet. So if you just think about that in terms of the China's lower class moving into the middle class and the implications of that, they're just phenomenal. So don't lose sight of where all the new economy applications are going to go with over 1 billion people. It's just staggering. Contrarians look for what is out of favour and is cheap, and at the moment there's really a couple of areas that I'm focusing on. One is energy, which I've mentioned over the last couple of weeks. US banks, which are out of favour, and look, I'm very cautious on European banks. In fact, I think there's a really significant problem emerging with Italian banks in particular and European banks in general. And I'm also pretty cautious about the Australian banks as well. But I think actually US banks, for a combination of growth and current valuations, offer some interesting alternatives. And of course, I think Chinese stocks are being priced for a hard landing, and I don't believe that's going to happen. So I think there's perhaps an opportunity emerging there. So let's get on to American stocks in general. The S&P was down 20 points on the week. There was a big blip in volatility the Friday before last, and that just got amplified by the computer algorithms, as I've discussed. I don't think we should place any long-term consideration to that. It's certainly short-term, it can have an impact. But I would really encourage you just to ignore the market noise around the Fed announcements of this week and basically forevermore. It's just not helpful to try and focus on that. The short-term support levels in the market held, and the S&P remains within its trend channel, as we'll see in just a minute. I'm expecting volatile conditions to continue throughout September, particularly around the Fed, and particularly given that big blip that we had down. It disturbs people's psychology, it makes them nervous, and therefore I would expect markets to remain nervous for a little while longer. And if you don't think about the market in terms of human psychology, then you are missing a massive part of it. Just think about how the psychology has to play out. We get a sudden big shift in the market. People turn negative. Some people sell straight away. Some people take a few days and others take a few weeks. And that's just a process that has to play out. And that's why I think we're going to see a little bit more to the downside yet. Now, I've got a fundamental, or before I go there, let's just look at the S&P chart and a few other charts. So we'll start here with the S&P. Let's just grab a big look. There's the run from 2008 from just under 700, and we've been up to almost 2200. We've had a fairly choppy 2 years here, particularly 2015 was very choppy, and now we've broken out. We've come back. We've retested that breakout zone. You can also see that I've drawn an upward sloping trend channel here, and I basically set that by putting a line above the highs and then just creating a parallel line to that picked up these lows here, and I'm working off closing prices, not the intraday spikes. And I am prepared to ignore this big blip down here. This was around Brexit in late June. That really was only down for 2 days, and then 2 days it was back in the channel again. So Technically, I think you can accommodate those sort of sudden excursions that only last for a very, very short period of time. So there's an upward trend channel there. So the 2016 level, which is the 38.2% retracement. So what I've done is I've placed a retracement scale on this last run from the Brexit lows, and that gives us likely support levels at 2116, and 2093, and 2069. Now, here's the culprit. This was Friday, the 8th of September, sorry, the 9th of September, and that has disturbed the psychology of the market. People are very nervous. This is the time of year when we tend to get some downside in the market. So I think there's a reasonable chance, probably better than 50% chance, that we will see 2116 broken. There'll be something that'll trigger it in the next few weeks. Might be the Fed this week, who knows? Doesn't really matter. So then I'd be looking for next support at 2093. So that's sort of what I'm expecting at the moment. But as always, you've got to remain open-minded about things. Let's just quickly look at the NASDAQ index. There's the NASDAQ, as you can see, trading up basically at all-time highs. So when you see that we're not at a market top. I can tell you that for sure and certain. And if we look at the Russell 2000, it's also pretty close to all-time highs. It's not very far off it. Again, if the market was rolling over, the small caps would be down here somewhere. They would have already broken lower. So that is one of the key reasons that I'm not too concerned about what this market does in the short term. Just while I'm here, I'll just touch on Deutsche Bank because I've referred to this several times. This is Deutsche Bank, which has traded down from $160 in 2007 and is now at 14. You don't need to be very skilled at anything much to know that there's something disastrously amiss when that happens. This is the red line is the 200-day moving average. We're still miles below it. The 50-day, the blue line, has remained below that basically for, let's just back up here a little bit. Basically, the last time it was really spent any time above that level was back in 2014. And we've done absolutely nothing. We're perhaps forming a base. We got up to around 15, but then the price dropped by nearly 10% on Friday night when Deutsche Bank got slapped with a $14 billion fine by the US Department of Justice for indiscretions rising out of 2008. And the fundamental concern about that is that, and I don't think in the end they'll end up paying $14 billion. They'll end up paying something less. But nevertheless, their bank balance sheet is not looking all that flash, and I think that could have a significant impact on their balance sheet. So not particularly good there. Now, coming back to the S&P, I've got a fundamental target around 2,300 points, and I arrive at that by assuming $128 earnings for the S&P 500, and there's a lot of data around this if you follow the US market. We've just done $118 for 2016, and that was with the energy sector and the transportation sector weighing very heavily on earnings. I believe the worst is over for the energy sector, and there are some better signs in the US transportation sector as well. So I believe both those sectors will rebound and add to earnings. So an 8-9% earnings growth into 2017, I think, is fine. The consensus estimate at the moment is 134, so I'm coming in about halfway between those 2 points. So I'm fairly comfortable that that's achievable, and I'm assuming that the current market multiple of 18 times is sustained. And whilst that's above the 15.5, which is the normal long-term average, I believe it's fair to acknowledge the really ultra low interest rates, and therefore paying 18 times for earnings in such a low interest rate environment, I think is not too over the top. So if you multiply 128 by 18, you get 2,300. So I think that's a reasonable fundamental target. Technically, I believe at least 2,300 and possibly up to 2,500 from a purely technical point of view is likely and possible. 2,300 represents only a 170 point run from the breakout. So that's only an 8% gain for the next leg up. So we had six years up, 2 years sideways, and another year or two up, and only 8%. I think that's pretty minimal. So therefore, for me, a technical target of 2,300 is easily achievable. Coming a bit more into the shorter term, if 2116 breaks, then expect 2093 for support, as I indicated before, and that huge breakdown on September 9 is just likely to play out a bit further. However, if 2116 does hold this week, then that would be a positive sign. So if we can get through the Fed and 2116 holds, then I would probably amend my position a little bit on what I said earlier. Turning now to Aussie stocks, the Aussie dollar was lower, back into the channel. 74.9 was the finish. Our index went down by 43. And as I said last week, there are opportunities in the Australian market, but you've just got to be very selective, and you've got to be very disciplined about your entry. So you've just got to focus on the businesses of real quality, where the earnings are visible for the next couple of years, and buy the technical dip. That's really the only way to do it. Let's just take in a couple of other charts. This is the US dollar index. So you can see quite a big jump on Friday night, and that's why commodities were down a little bit, except, well, I'll come back to that, except for copper. So there's the US dollar. This is the Australian dollar. We had a little bit of a blip out of our trend channel. That's okay. We can accommodate small deviations, and we're still back in this big picture downtrend. But really, it's been pretty much sideways for most of this year, certainly since March. And just one other chart I want to look at. This is the VIX index. So we had a couple of decent spikes, but we're declining again now. But we're certainly not out of the woods being September, that's for sure. Let's take a look now at the Australian market. There's the ASX 200. Let's grab a bit more data. You can see it's just such a different pattern to the US market. We're trading at the same level that we were trading at in 2013. So the index has had no growth in 3 years. And I really don't see that changing a lot, because I really struggle to see upside in the Australian banks at the moment. Turning now to precious metals, gold was lower by $17 on the week, and that was largely because of the strength in the US dollar. And I've had some questions about why gold has been languishing of late. Part of it is, you've just got to give these corrective phases time to play out, is the main one. But from a fundamental point of view, buying of gold into GLD, which is an ETF that tracks the price of gold, has been one of the critical drivers in driving gold and gold stocks higher. And that buying has abated somewhat in the last month or two, and really that's it. So the question is, what would bring that buying back into GLD? Look, I think certainly some fear in the market, a bit of disruption in the market would certainly bring that back. Some supportive data of economic growth, I think, would actually be a positive, because that would suggest that we're maybe returning to a bit more inflation. But look, we've just got to wait out this period. We're still not anywhere near the maximums yet, so we've got a bit more room to extend a little bit longer. Now, I just thought I'd address the question, what happens when the Fed raises rates? Because a lot of people, or the consensus thinking seems to be that when the Fed raises rates, that then it's all over for gold because gold is not attractive in a rate rising environment. And as with a lot of these sort of commonly understood rules of thumb, they're mostly wrong. And if you look at the data, and I've seen some quite specific research data on this, 60% of the time when the Fed raised rates, started a rate rising cycle, then gold was higher 3 months later and also 12 months later. So 6 times out of 10, gold actually went up when the Fed started raising interest rates, and that's a fact. And 12 months later, the average gain was 7%. Now, you can kind of trick yourself up if you just look at averages and assume that the average is going to apply this year. So that actually doesn't mean anything in terms of, or doesn't guarantee anything for what might happen this year. However, what it says to me is that we shouldn't worry about the Fed raising interest rates. So, just forget about that and just trade what's in front of us, because 60% of the time, gold and gold stocks have actually gone up. So it's not really something that we should be concerned about. And the other point is, and this was really quite staggering, is that the gains in gold were twice as big as when the Fed didn't raise rates or when they lowered rates. Now, I know that that's quite counterintuitive, but those are the facts, and we have to acknowledge them. And I think part of the reason for that is that when the Fed is raising rates, generally it's associated with a strengthening economy, which is generally associated with rising inflation. Now, whether that historical data means anything this time round this year, I don't know. But again, let's not get caught up in those old wives' tales and just assume that it's going to occur again. I think if the Fed does raise rates in September or December, I think we'll get a bit of disruption. There'll be that immediate sentiment reaction to it, and then it'll all just settle down and go away. Now, over the last couple of weeks, I've mentioned that the normal price and time for a correction phase in precious metals is typically 3 to 6 weeks. We are now 4 weeks in, so we've still got potentially another couple of weeks to go based on history. And also, the typical average depth of the correction is between 27 and 54%, and so far we're 35%. We've retraced of the gain. So let's take a look at the gold. So let's look at gold first of all on a weekly basis. So we've had a really good run from 1,050, and we really haven't lost that much ground. We've been holding above 1,300 now since the end of June. So still looking reasonably good. We ran up to the 38.2% retracement, and now we're just positioning just underneath that level, which is at 1377, and I fully expect the next significant move to be to the upside. Let's look at it on a daily basis. Bit of a dribble down last week, but that's really associated with the US dollar. And there's silver reacting pretty much the same. Let's look at the gold stock indices. This is GDX. There's a couple of target bands that I'm looking. One is around this 38.2% retracement, which on GDX is around 24.4. We didn't quite get down to that level. Had a bit of a bounce, and now we're going to go down and retest it again. If that level breaks, then I'd be looking for the 50% retracement, which comes in around $22 on GDX. So they're the two possibles. So from 26 down to 22 is another perhaps 15%. That is possible. I'm not saying that's going to happen, but if you are not able to accommodate another 15% downside, then your exposure is too high, because there's no one on the planet can guarantee you that this won't fall another 15%. And yet a 50% retracement in a bull market, there's nothing Nothing about that says that the bull market is not continuing or is in danger. You've just got to accept that if you want the upside in precious metal stocks, which is considerable and it's hundreds of percent, then you have to be able to accommodate the 50% retracements of the gains from time to time. It's just part of the game. Turning now to commodities, copper actually went against the trend to $2.16. So there's another bit of an anomaly. The US dollar went up, but so did copper. Is that a sign of future economic growth coming down the pipeline? Quite possibly. So we'll have to see how that one plays out. Crude oil fell to 43. That was a dual effect of the US dollar going up and also some data, but I just want to point to the inconsistency of this data. 3 weeks ago, the IEA, the International Energy Association, said that production was lagging demand and therefore the oil price was likely to go up. Last week, they said that oversupply would be persisting into 2017. Now, those two statements, issued 3 weeks apart, are completely in conflict. Well, they're not totally in conflict, but they certainly send two very different messages about the energy market. So, if you're hanging out on this data, it's just noise, and you've really got to step outside that data. And this is where the charts are absolutely invaluable. You've just got to look at what is, because the charts are looking forward, and you've got to look at what the market is telling you. Price is going to tell us when change is likely. So on that score, let's just take a look at the XLE, which is the ETF covering the US energy market. And let's just clear our mind of what we think should be and look at what the market is telling us. So we had a dramatic decline from July of 2014, from 100 down to 50. So the energy market halved. You can see the red 200-day moving average line was falling. The price was below it, downtrend, simple. The 200-day moving average has now leveled off, and one could argue might be rising very slightly. The blue 50-day moving average line has cut above it and is now rising, and the price is above the 200-day moving average. Now, I'm not saying that energy stocks are a raging buy at this point in time, but you have to acknowledge that that's a change in character. Now, we could come back down here and maybe retest these lows, I don't know. But certainly you have to acknowledge that there is a change in character occurring. So the energy market is definitely one that is worth watching, no question. Whether it's ready just yet or not is another issue, but there is potentially a lot of upside in the energy sector because a lot of the doom and gloom is priced in. There's the spot copper chart showing a nice little blip during the week. So just to wrap it up, and I appreciate this has been a longer session, but a lot to talk about. Considered contrarians win out. If you're just a contrarian for being the sake of it, then you're probably going to get your head handed to you. But if you're a considered contrarian and you use the charts to tell you when the confirmation occurs, then that's a pretty good way to make money. Ideally, look for sectors that are out of favour and that are also cheap. Those two things tend to go together. And exploit the short-term negative sentiment to start to build into new emerging trends and be patient, because sometimes it takes a while. Precious metals, a long time ago, you should have reduced your exposure to bring it back to an appropriate level for you for a corrective phase. Be able to hold your nerve through the volatility, because it can be scary, and that's where most people need assistance. And ramp up your exposure according to the patterns. And at the moment, I'm not seeing anything that would tell me that we should be ramping up our exposure just at the moment, but I'm sure that will come soon. Ignore the analysts. As an example, Apple was a sell at $90 in May, and now the analysts have got it as a buy at 116. So it's gone up 26, what's that, nearly 30%. And they've now gone from a sell to a buy. And following analysts is just a great way to lose money. Stay with the chart patterns until they change. Keep an open mind always, and that's how you make money. That's it for this week. There's my contact details for those that would like to talk to me about how I may be able to assist them if you're not a member. And of course, members, we're just sitting tight for the minute and looking forward to the opportunities. So that's it for this week. Cheers.